gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Good morning, ladies and gentlemen, and very excited as always to have Doc Wilson with us for the weekly market update. How are you, Doc?
Yeah, really good, Graeme, and we've certainly got some big news today. The market is evolving, and it's certainly evolving in a positive sense. So look forward to that data. And we also have for the latest economic news as well, and that's very interesting in terms of the future direction of interest rates. And I notice our glorious Reserve Bank governor's been at it again with some comments before Parliament, which have set the horses running in terms of the prospect, hang on to your hats, of a 9% unemployment rate, according to the good governor. So we'll have a little bit of a chat about that one.
9% unemployment rate.
Well, the governor thinks that that's possibly where we could end up if we can't get inflation under control, and that means.
So the counter of that, Doc, is he's insinuating he's going to keep putting rates up until that occurs.
I think he mentioned it as a possible outcome. If we don't get inflation under control, we may end up with a 9% unemployment rate. But of course, immediately you give yourself a number or commit yourself in a sense to a number, the media are all over it. In fact, some parts of the media actually said that he meant a 9% interest rate.
Wow.
But and of course, it doesn't really do the mindset of the market or of consumers much good when you're talking about a 9% unemployment rate, which, let me be loud and clear on this, would be horrific. And we need to avoid anywhere near that number at all costs. So, it's just another headline from the Reserve Bank, which is very questionable.
Well, it's the old, you have nothing to fear but fear itself. But, hey, it's a good headline.
Well, it is. And, when we look back in history, that 9% rate, which, is speculative and, it's just a phrase that was thrown out there. If we did get 9%, we'd be up around the levels what we had in the early 90s with the recession we had to have. Remember that one?
Yeah.
And that drove unemployment up to double figures. And, of course, it did cost eventually the then Labor government its gig. And it really took the best part of 10 years to get unemployment and growth back to what we consider more of a normal level. And, the result of 10%, unemployment rates is the destruction of lives and livelihoods, and you just can't get those things back. And it's a terrible scourge on the economy to be, considering policy positions that may push our unemployment rate up to, really terrible levels.
Yeah, you got to ask, Doc, is it a bit of fear-mongering to go, everyone needs to stop spending? We can't, the textbooks and we as the Reserve Bank can't control inflation. Maybe if I start sprouting some stuff out there that's headline, maybe we can scare people into controlling inflation.
Well, okay, megaphone economics, I don't think that's appropriate certainly in the medium term. But as I said, it can become self-fulfilling in that sense. And it's, the latest unemployment data, which we'll look at shortly, Graeme, is starting to give some very early signs that higher rates may be working. Our economy is still very, very strong. But, it's the first sign that we may have peaked in our labour market. And this is what the Reserve Bank is looking for at that end, is to see that we are having higher unemployment and reducing demand. But the big game is inflation, Graeme, and we don't want to have unemployment rising but inflation staying the same. It's like, well, just because we have higher unemployment, will it mean inflation will fall? That's what the textbooks tell us. But the textbooks got it wrong in the reverse environment 4 or 5 years ago, Graeme, pre-COVID, where central banks were trying to re-inflate the economy following the global financial crisis. Interest rates, official rates got down to 0% in a lot of jurisdictions. Didn't work, mate. Now we're in the reverse, where we're trying to deflate our economies with higher interest rates. But hello, it's not working either at this point of time. So maybe those dusty old economic textbooks need to be thrown out, and we've got to think of other policy positions to try to fix this terrible problem that we have at the moment.
The textbooks aren't working. Hopefully he's not trying the megaphone. But like you say, look, it could be a self-fulfilling prophecy. You put it out there into the world. It's pretty scary.
Well, if I was a politician, I'd be really worried about a 9% unemployment rate.
Politician, I'd be worried generally for any of us in a society if that happened.
Well, these comments worked at Parliament, and of course we have a Labor government here, and their mandate typically is to look after the worker. I'm not sure they'd be terribly happy with throwing hundreds of thousands of their constituents out of work. So I'd suggest it was a very sobering meeting, and I'm not sure that even mentioning these potential outcomes is going to work as a scare campaign or a scare tactic. But certainly, perhaps its positive would be that we've got to think of other mechanisms to avoid that outcome, other than scorchingly high interest rates. But it's all unfolding as we speak. As I said, those latest unemployment numbers give us some signs, consolidating signs, that we've reached the peak of our labour market performance. But let's not be doom and gloom about the economy, because it's still charging ahead on all 8 cylinders, let me tell you. But it is signs that higher interest rates and perhaps migration is starting to rebalance our very low, or our very strong, very tight labour market. And that's the plan, really, at the end of the day, to try to control, inflation. But I don't see any real signs that inflation is, where it would hopefully have been a year ago in terms of the forecasts from central banks.
Well, you know what, that's pretty scary to set the tone this morning, Doc, but you know what's not scary? The current housing data you're about to share.
Yes, well, that's I guess that's all part of this booming economy, Graeme, is that I think all the doomsayers have headed back into their caves, now waiting, of course, probably the bubble mantra will be released soon. Oh, we're inflating the bubble, et cetera, et cetera. The bubble that keeps on giving if you are a doomsayer, because we have some very strong results, particularly in that Sydney market from the weekend auction clearance rates. And I've also got some supporting data for that. I don't want to give too much away because the end of the month is coming up in a week. Next week, I'm going to give a preview of what's happened with prices, house prices over February. And there is some surprising news there, Graeme, if I could just give a heads up, particularly for the Sydney market, in terms of how they've tracked over February. But we shouldn't be surprised, given where auction clearance rates have been over the year so far, that we're getting the usual reflection of that in house prices. So I'm not going to give too much away, right?
No. Well, let's not give it all away, but let's maybe jump in and have a look at the data this week, Doc.
Absolutely, Graeme. So the latest data, Graeme, and here it is in all its glory, brought to you by My Housing Market. And as I mentioned, the economy is still booming, and we did have the unemployment data out for January. It was released last week, and that's our first real, economic data for the year, because these are January results. And we had an increase in the unemployment rate, Graeme. Reiterating that the unemployment rate is still very, very low. But the unemployment rate picked up to 3.7%. Once again, any unemployment number with a 3 in front of it is really quite remarkable, Graeme, and there's no way known we should be saying that this is an economy that's tanking in any way. And it's still the lowest numbers that we've had since the early 70s. And it's the lowest numbers we've ever had in terms of the monthly surveys. And the surveys back in the early 70s were quarterly surveys. And of course, when we look to the early 70s, Graham, it was a whole different Australia, let me tell you, single income households, etc. So this is a remarkably strong economy, a remarkably strong labour market, regardless of unemployment rising over January.
And Doc, looking at the graph there on that data you're providing, if you really look at that COVID era, that jump there, you can see that whole sort of from the, sort of fairly stable up and down in the fives.
Yeah.
That COVID period where it did, people sadly lost businesses and livelihoods and certain industries couldn't trade. But you could, even then at a pandemic, like a global crisis, no one could leave the home.
Yes.
Yet Philip Lowe's saying 9%, we got to 7.5% then.
That's right, Graham. And, our previous peak post the, depression, which is, moving on to 100 years ago, was that 10% result we had in 1990-91 as a result of that, of the recession then. So it brings us back to what were horrific economic times then. So I think even mentioning, I don't think it's acceptable for the Reserve Bank to even be considering an unemployment rate, above 6%, to be quite honest. I think once you get to 6%, then that's it. Sorry, we're going to accept that as being the ceiling for unemployment, and we have to leave it to other policy levers to try to control inflation, such as fiscal policy, that is government spending, etc. But as I think, we've come from a period where we understand, maybe we've forgotten, the impact of high unemployment on not just our economy in terms of how long it takes to fix that up, but also, at the basic level on what it does to people's lives. And we just can't be accepting policies that result in very high levels of unemployment and just say, well, it's just what the textbooks tell us to do. This is what we do. So sorry about that, but let me tell you, governments won't survive that level of unemployment.
Maybe it's also a bit of maybe it's arse covering. If I come out and megaphone out 9% and we end up at 6%, how well did we do? We didn't get to 9%, we got to 6%.
Yeah, that's if we can control inflation, Graham.
Sure.
The problem we have with inflation now is that we're starting to see, as we've discussed, inflationary pressures moving into the services sector, which really does reflect the impact of higher wages on employers having to cover them by putting up their prices. Now, this week we're going to get the latest wages data out. It's a bit backward looking for the December quarter. That should see another leap in wages, annual wages growth. But that's the problem. As wages rise, of course, employers have to cover those wage increases, and that means higher prices, which again creates the environment where workers want to cover those higher prices, again pushing up wages, and we move into that sort of spiral relationship, which is what reserve banks are trying to avoid. And I'm not suggesting we should live with that in any way, but I think that living with extraordinary high levels of unemployment is not acceptable. And people are put in government and are given positions in terms of policy making, such as the Reserve Bank, to avoid these occurrences. And it's no use. It's no good just saying, oh, sorry, it's not our fault. It's happening everywhere. Well, you get the big bucks. You've got to do the work and not just wash your hands of the consequences.
Yep, absolutely. Absolutely. But
so that's
at the moment, increased a little bit, but still pretty stable for unemployment.
But when we look a little closer at the data, we look at the capital cities here, Graeme. Well, these are the states, actually. We can see those numbers are lower across the board. So it's not just, that low unemployment rate a result of, a particular state outperforming other states. There's no states here have been left behind in terms of their labour market performance. They're all lower than they were a year ago. They're all in the threes, with the exception of South Australia, which is just at 4 there. And the only state which hasn't recorded a fall over the year is Western Australia, but nonetheless, they're coming from a lower base than everywhere else a year ago, which just shows you how strong that Western Australian economy is. That over the past year, it's been able to sustain a extraordinary low unemployment rate. But let's have a look at a bit more depth in the numbers, Graeme. And I think this is interesting. The January jobless increased to 3.7%. It's actually the highest unemployment rate, Graeme, since May last year. So, it's still low, but it's higher than it's been since May last year. We also lost jobs over January. They were down by 11,000, fall in employment. And that followed a fall over December as well, Graeme. And that's the first consecutive fall in employment, that's month to month, that we've had since way back in August 2021, where we were in the depths of COVID lockdown. So your first consecutive fall in employment since way back in the depths of COVID. The number of unemployed was also up again over the month, up by 22,000 increase in the number of unemployed. Again, that followed an increase.
But the participation rate's down.
Yes, the participation rate was also down, Graeme. And that, of course, is the proportion of the population that is counted in the workforce, down to 66.5%. Now, that's still a very high participation rate.
Yeah.
So we're still getting a near record proportion of our population that are working. But once again, it's the lowest participation rate we've had since May 2022. So, the market is still, the labour market is still very tight, Graeme. It is still a very strong economy. It's a booming economy, but it is now starting to show clear signs that it has reached its peak. And is this because of higher interest rates and, of course, the surge in migration, which is providing us with more workers to be able to soak up available jobs? I think it is. And it had to happen because Reserve Bank, would have been, well, what can we do? Nothing's happening. We've still got a booming economy and high inflation. Well, at least now the Reserve Bank can, I guess, say to themselves, well, it looks like it's starting to work. This is fine. We can now go a little bit easier on interest rate increases because these things can gather momentum. And if we start getting month after month with similar declining numbers in terms of our performance, higher unemployment rate and falling employment, falling participation rates, then I think the Reserve Bank will say, okay, we need to wait and see now and maybe just leave rates where they are just to see that, because we don't want this thing building momentum and ending up with, significantly higher unemployment rates. I think that 9% stuff is cloud cuckoo land commentary. But, maybe you're right, it's a bit of megaphone scare tactics from the Reserve Bank governor. I think maybe we're giving him a bit too much credit. But anyway, you never know. But I think that's a sort of a good news, bad news story, Graeme. The good news is that the bad news is that the economy has passed. It looks like it's passed its peak in terms of its labour market performance. However, it is still very, very strong, unequivocally strong. But the fact that it's past its peak may mean that the Reserve Bank is feeling a little bit happier about where it can finish in terms of higher interest rates. I still think they'll probably be a tick over 4% when we finish. I think that's probably one interest rate increase, 0.25% higher than maybe we were thinking about in before the latest inflation data. But nonetheless, it's still well below where we peaked way back in 2011, Graeme. So I guess after looking at the economic circumstances, and like I said, good news, bad news story, let's have a look at those weekend option markets. Very exciting news here, Graeme.
Doom and gloom.
No, mate, no doom and gloom here.
No doom and gloom here.
No, well, we're just looking at the facts here.
Then we're not going to get a headline at all, Doc.
Well, no, but those that are engaged in the market are going to feel pretty good about their prospects going forward based on. And we're not about headlines, Graeme. We're about the reality of providing robust information to consumers out there so they can make decisions based on the facts, not based on hysteria. Which of course,
people need to be making educated, informed economic and financial decisions, not clickbait decisions.
And that's where the educators, Graeme, and that's what this is about. Reality. Focus. So those in the market or thinking of being in the market, can, make rational decisions based on evidence.
Well, let's get real rational. What's the evidence, Doc? Let's get real logic on this.
Well, we know that auction clearance rates, and we show this chart every week, Graeme. I think it's important because auction clearance rates are a focus of market insights, and that's why, because auction clearance rates clearly show us where house prices are moving. That's the Sydney clearance rate versus the Sydney house price, and the same story with Melbourne. No surprise there that the relationship is the same. So look at those weekend auction clearance rates. They will tell you what's happening, Graeme, in terms of house price movements. And this is the latest data, Graeme, and this was, I don't want to overstate it, but to be quite honest, getting a 75.6% clearance rate in Sydney on the weekend from what were, quite reasonable numbers of auctions. In fact, auctions were up versus the previous weekend. But this is 3 weekends in a row, Graeme, above 70%. And 75.6%. And I'm not going to roll out the B word. I'm telling
you. Almost boom.
Well, it's not far away from 80%, and that's our benchmark for a boom. But I'm not going to roll it out yet. We need to have a few weekends above 80%.
We're 70, 75, 76. Geez, we're pretty close to... Oh, you know what B word we should use, Doc? Let's call bullshit on some of the predictions and the doom and gloom. Before we say boom, we'll call bullshit.
Yeah, that's all right. Well, I think that's pretty much already there, Graeme, because if we look at the results, firstly, significantly higher than the previous weekend in Sydney, where, and as I said, auction numbers, although not as high as they were a year ago, we've got to remember that we're at the back end of a boom. So people were flooding into the market, sellers were flooding into the market to take advantage of extraordinarily strong positions. But given all that, we're now starting to close in on Sydney and the other capitals on where we were a year ago. So that's another sign. We know prices were still rising rapidly a year ago. So the clearance rate is now closing in on where it was a year ago. It is rising. The trend is rising. A year ago, it was falling because it was coming out of the back end of that boom. And we're well ahead of where we finished off at the end of last year, Graeme. And typically auction markets start the year around about where they finished the year. Now, we finished the year in the low 60s. We've started the year 3 weekends, Graeme, in the mid 70s. This has really, put a lot of the doomsayers back on their heels, because this is a strong market. 75.6% is a strong market, Graeme, and it is now starting to look like a seller's market. In other words, it's a good market to be a seller in because you've got more competition from buyers out there for your property. Now, again, it's early days, Graeme. Let's put in the disclaimer, 3 weekends into the year. We need to see some more results, but we've been saying that for a couple of weekends now, Graeme. And every weekend we continue to see these very strong results in the Sydney market. Now, of course, auction numbers will continue to rise as the year matures. But you can't argue. In fact, it's a surprise on the upside, these numbers, and it shows that consumers are up and about. A strong economy is giving them confidence, and they want to get into the market before prices start to rise, Graeme, because they're...
Even Melbourne, Doc. Melbourne's had a couple of hundred extra pieces of stock and still cleared in the mid-60s.
Well, big surge in Melbourne auction numbers, Graeme. 66.7% clearance rate, which is now starting to, move between a buyer and a seller's market in favour of sellers. Not there yet. Typically, of course, Melbourne does ramp up the market quite early in February. We have the Labor Day long weekend coming up in 3 weeks in Melbourne, 4 weeks in Melbourne, and the weekend before Labor Day is the first Super Saturday of the year. So we will get some big auction numbers coming through in Melbourne over the next few weekends. That will test the market. Let's see if it can stand up with these clearance rates, but that's still quite a reasonable clearance rate, given 200 extra auctions on the weekend. Brisbane held its own with more auctions, 70% clearance rate. Adelaide just continues to be the strongest performer of all our markets, which it's been for most of the past year. And Canberra down a little bit. The Canberra markets softened somewhat. I mean, it's still a reasonable result around about where it finished last year. I think there's some shorter-term economic issues with Canberra at the moment, maybe reflecting on the change of government we've had as well and its impact in the short term on public service activity. But nonetheless, we can see that with the exception of Canberra, these markets are performing really well with numbers that are clearly in favour or certainly moving towards the favour of sellers. But we await the results of the next few weekends, Graeme. But that Sydney number is just, quite remarkable.
Stay tuned. Watch this space.
And as we always say, it's sort of so we're focusing on Sydney for any particular reason, but we need to focus on Sydney because, as we know, the Sydney and Melbourne results set the tone for national commentary on housing markets, because where Sydney and Melbourne go, that's where the national house price goes, because the national house price is basically Sydney and Melbourne. And if Sydney's rising strongly, you can bet your life that the Sydney or the national house price is also moving in an upward direction. So let's have a look just at those monthly results to just show us where we are. We can see that clearly the market has increased in Sydney since the end of the year last year and is closing in on where it was at a year ago in February. Similarly in Melbourne, well ahead of where it finished last year, and but still below where it was a year ago. But it too is getting closer to that result of a year ago. Brisbane higher again the end of last year, but well below where it was the same time last year. But of course, we know that Brisbane was going through a remarkable boom driven by southern migrants, which created some extraordinary results in Brisbane a year ago. Adelaide's still strong, not that far away from where it was a year ago either. And the Canberra market, the underperformer, and as I said, some local factors impacting that market likely to start the year. Now, these are, I just thought I'd put this one in, Graeme. These are the prices, the median house prices at auction. So this is the median house auction price last weekend compared to the same weekend last year. Now, no surprise, because markets were booming and there was a lot of momentum there, that most of the capitals, house prices last weekend at auction are below where they were a year ago. There is one exception, Graeme. Have a look at that Sydney market. Sydney's median house price at auction last weekend is now higher than where it was a year ago. So, these are auction results. They can be volatile, but I think that stands out as a difference between Sydney, as a difference with the rest. And next week we'll get the release, and we'll do it on our podcast exclusively, a pre-release on the actual full market's house prices, how they've tracked over February.
Sorry, Doc, just click through. We're missing the cities under the graphs there.
Oh, sorry. Okay. Sorry, but we've got Sydney left to right, Sydney, Melbourne, Brisbane, Adelaide, and Canberra.
There we go. So, guys, just Sydney. Say that again, Doc, in case anyone.
Left to right, Sydney, Melbourne, Brisbane, Adelaide, and Canberra. So, yes. Oops.
I was following along and went, I'm a bit confused here. There we go.
Sorry about that. It happens sometimes. Rarely, but there it goes. So you can make up your own settings if you like. No. Right. And Sydney's the one there where the auction price last weekend was higher than the same weekend a year ago. So the price data on a week-to-week basis can be volatile. But let's see how it pans out when we look at the results next week, the preliminary results next week for the full month of February, with all, not just the auction market, but all sales that have come through in the month. That will be really interesting. So I want to build up the tension. I want to build up the anticipation for next weekend. So look out, and you'll be the first with the news here on what's happening in house prices. And will we see the same relationship between higher clearance rates and higher house prices? This is exciting stuff, isn't it, Graeme?
Well, it is for us.
Anyway, if I click through there, you can now see the capital cities.
There we go.
Slide. So I just didn't click through fast enough, Graeme. So
that's all right. That's why I thought I'd ask, just in case.
Yeah, well, there you go. And I just didn't click the button. Well, the button's clicked, and we can come back to reality in terms of exactly what we're describing there. So, of course, you can get those option clearance rates every Saturday night. The headline rates on my LinkedIn account, Doc Andrew Wilson at LinkedIn. And every Sunday morning, you get the full national report. And, of course, Graeme's presentations and podcasts always cover what's happening in the auction market. And as we said, it's a very positive forward indicator of what's happening in our housing markets generally.
Beautiful. Well, I don't know, Doc. There's no negativity there. So
No, Graeme.
Everyone stay tuned. Big data coming next week. Big data.
Yeah, plenty of momentum in the market at the moment, Graeme. Early days, we continue to say that. But the next couple of weekends will reveal more about the market, of course. Every weekend is another part of the storyline for housing market activity. But I certainly think that even the optimists would have been somewhat surprised at how strong our markets have started off this year. And let's remember, Graeme, we've had an interest rate increase 2 weeks ago. And it's every month since May we've had an interest rate increase, with the exception, of course, of January, where they don't meet. So, and we're building momentum. And dare I say it, we may be even getting a whiff, just a whiff, of the fear of missing out, FOMO, starting to head into that Sydney market. Can you believe it?
Well, everyone that thought they were going to wait for the crash that didn't occur, it's still going up. They're now well priced out of the market.
Well, we'll see. And the price data will be interesting for this month, Graeme. And of course, it's just February, right? It's still, to a large degree, the holiday mindset is still there. But I do think we're going to see when we do see, depending on the price results as they come out, people will realise perhaps that this is the time to get in before prices are even higher.
That's right. Well, there you have it, ladies and gentlemen. Make sure you stay tuned for next week. Some big data. Thanks as always, Doc.
Yes, thank you very much, Graeme. And the storyline just keeps on getting more interesting, doesn't it?
Sure does. Thanks, Doc.
Thanks, Graeme.